So welcome back, everybody. I know that a lot of the value of these types of conferences is the chance to network and make new friends and get reacquainted with others, but thanks for coming back. So this presentation, we're going to talk a little bit more detail about what goes into the elements of a successful de-SPAC transaction. So I'll do the obligatory very fast advertisement. So I'm Crocker Coulson, CEO of AUM Media. We do investor relations, capital markets advisory, and media relations. We have right now very, very big focus on the Southeast Asia region, as you no doubt have gathered. I think the things we see ourselves as key advisors during the de-SPAC process, and helping both management teams and the SPAC management figure out a path to optimize the outcome of this transaction. And that's true both in challenging conditions that we're in today and in more ebullient markets that we've seen in the recent past. My personal background is between 2005 and 2010. My former firm was the largest investor relations firm for Chinese companies listing in the U.S. So I helped over 100 companies from China list in the U.S., many via traditional IPO, some via SPAC mergers. That was happening back then, but not in the volumes as we've seen today. And then back then it was very popular to do a reverse merger with Big Pipe, which was kind of another version of the same thing of raising committed capital and getting public. That has fallen into disfavor and I think has a lot more regulatory obstacles today than it used to. We see our core competence as working with the senior management team to understand their business model in a deep way and then translate that into terms that are going to make sense to investors. So taking the thought process and the strategy of management and translating that into the language of Wall Street and things that people on Wall Street can understand. And particularly in Southeast Asia, I think there's an enormous job of education that has to happen. Some of that is going to fall on the investment banks. Some of that is part of our role, and some of that, hopefully the exchanges will play a role as well. We're very focused on using digital tools wherever possible. We have a comprehensive offering, and we have an extensive network of SPACs with dozens of SPACs that we know are currently looking for targets. So, and in some cases helpful in making those introductions. Because I've been doing this for better or for worse for a couple decades now, have connections with all the investment banks that are active in the small cap arena as well as the larger investment banks. So I wanted to just start out with some SPAC myths, and these are kind of SPAC myths circa 2020, 2021. So one of them was on valuations, and people said that the wonderful thing about a SPAC is that you can negotiate your own valuation. You don't need to rely on these evil investment bankers to go collaborate with big mutual funds and push your stock price down in an IPO. We're going to bypass them. We're just going to sit in a conference room and decide it. And for that reason, they said, okay, well, that's going to result in a lot less dilution for the VCs that are backing the company and for the company. And they really said that for that point, they said, we're going to go around these bankers because they're these evil people who are always trying to give us less than we're worth. Now, of course, those of you who heard George, present, he's not an evil guy by any means, I don't think, as far as from what I know. And the fact is that the job of a banker is to match supply and demand. And that's, really the investment bankers, that's how they get transactions done, is by finding a way to match supply and demand in markets like these, often through fairly convoluted structures and transactions. But at the end of the day, they have to meet the needs of both sides. And there's really nothing particularly evil about most of them. But they are driven by profit incentive, which I assume the majority of the people in this room are to some extent as well. The other big headline was that we're going to democratize VC investment. So we're going to give these poor retail investors have been shut out of the opportunity to invest in space travel and flying electric helicopters and other inventions of the future. And those have been reserved only for the LPs of the venture funds. And now we're going to open it up to everybody, and everybody's going to get these huge returns. And then the other thing that was actually true for a while was that pipes were additive. So you would get the benefit of all the cash and trust, and then the pipes would be on top of that. So you get a super war chest that would allow you to go to war as this super well-funded private company. So this is now, SPAC reality, now that that initial buzz has faded a little bit. And this was always true. Valuations are determined by public markets and fundamentals. We did have a period in which capital had almost no cost. And so the market was willing to support very high valuations, even for companies that were not profitable if they had growth prospects. But at the end of the day, that never lasts forever. At the end of the day, companies' valuations always regress to their fundamental values. And instead of now actually a lot of the bulge bracket banks have actually orphaned their IPOs because they're afraid of the liability that is implied in the SEC's statements, even though they haven't, as Mitch noted, they never engaged in the formal finalizing the rulemaking. They've made it very clear that they see anybody who's involved as a financial advisor, a pipe placement agent, is subject to the same level of liability that they would be during an IPO. But it's actually worse than that if you're a deep-pocketed bank, because in an IPO, your liability is limited to the amount of proceeds that are raised in the offering, whereas in a SPAC merger, it's actually limited to the enterprise value because the whole thing could go to zero. So they actually have a lot more exposure. So that's why most of them have, with a few exceptions, exited the SPAC advisory business. And the fact is that retail investors, instead of getting this opportunity to get these exceptional VC-like returns, in many cases, they were the ones who didn't figure out how to redeem or forgot to redeem, and they were the ones who were left in the 5 or 6 or 7% of shares that are left in the deal. So they've borne a lot of the losses. And now pipes, rather than adding to your war chest, they do that to some extent. We certainly have a number of our clients that have been successful in doing either what they call pre-IPO or pipe transactions, where they are bringing in meaningful amounts of financing in conjunction with these transactions. In many cases, the pipes or transactions are used to meet the minimum requirements to list on NASDAQ. So this is what we see as the kind of opportunities and challenges for the market today. As of, I think, last week, there were 339 SPACs left in search mode, which means they either haven't found a target or they've found one and haven't announced it yet. And I should note that's down from about 470 in December, so you can see how quickly that herd is being thinned. And that represents about $74 billion in theoretically deployable capital, down from $123 billion back in December. Last year, the average size of a SPAC IPO was less than half of the prior year. And I think that's actually quite rational in terms of the range of targets that we see that are kind of appropriate for a SPAC. I think that size of the 100 to or even 50 to $200 million SPAC is a much more rational size than the huge mega SPACs that we saw back in the heyday. And that's because people have realized that there's a limited number of viable unicorns out there. there were, I would say there were a large number of what I would call fake unicorns, which had managed to get a paper valuation, above $1 billion through a funding raise. But I think the venture backers of those companies had realized that based on execution that was not a real mark. And those were the ones that they tended to move into the SPAC vehicle. And that is part of the story of why we've seen the underperformance of the vehicle in the aftermarket. And there still is this opportunity for committed capital. In fact, I would say a kind of requirement for committed capital via, again, pre-IPO round or PIPE. So that's the opportunities. I think they're very real opportunities. The challenges, and Mitch has already covered a lot of this, but we've had some de facto changes in the SEC rules, even if they haven't been fully papered. If you look at the comments that are coming back to registration statements, the SEC is acting as if they had passed these rules in their comments. And so there definitely is now the presumption that a fairness opinion is required when you have a read before the board votes on a definitive merger agreement. That used to be kind of the exception rather than the rule. And the level of and detail of comments that you're seeing from the SEC is very comparable to what you'd see in a typical IPO. Whereas I think if you go back to the earlier days of the SPAC vehicle, it was very light comments compared to. So they're based on Chairman Gensler's comments, they really have, aligned the level of expectations on disclosure. And that slows everything down, to be honest. That, one of the big arguments for SPACs was you could do it fast and cheap. I think that's less resonant and less accurate today. I think there's still some advantage in time and cost, but it's not necessarily as true as it used to be. PIPE investor, you heard, much more selective. I don't need to repeat that. Much lower acceptance for, I would say, aggressive, unsupported forecasts. So instead of seeing forecasts going out, 4 or 5 years in the future with a hockey stick with no kind of relation to prior revenue performance, I think we're seeing most of our clients are going out 2 or 3 years with their forecasts, and they're really building it up from the bottom up, and the everybody involved is really scrutinizing the assumptions behind that, which I think is a good thing. I think the SEC at one point signaled that they might want to try and eliminate forecasts from SPAC mergers. I don't think that's actually possible, because when you do a fairness opinion, it's always based on actually forecasts provided by the company. So they kind of get in either through the front door or the back door. So I think it's inherent to the vehicle. I don't think they're going away, but they are shorter duration. They're more grounded in reality. And then my good friends among the short seller community have their eyes peeled for every single de-SPAC, and particularly the ones that are larger enterprise value deals, and they're looking for any defects in disclosure or hype or defects in governance, and if they can find enough material to justify a 15 to 30 page report, they will publish that and make your life miserable. So why consider SPAC mergers today, given all that? So again, certainty of outcome, I said that at the beginning. It's not subject to market conditions. Follow the rules. You will be public at the end. It provides liquidity for investors. So I think there's a lot of companies where, their private investors came in 5 years ago. They've been very supportive, but they need to see the light at the end of the tunnel, right? They can't be locked up forever. They need to distribute to their LPs, or they have their own liquidity needs. And it allows you to do that without losing control. So in this type of market, your alternative often is a strategic or control sale. And basically, if you're a management team that's kind of ambitious and has a 5 or 10 year vision for what you want to do with this company, well, you're going to lose control if you either sell or you do a control buyout option. So this is a way to avoid that. In the best cases, and we are seeing that with some of our clients, you're bringing in an experienced partner. So you're bringing in a SPAC management team where they have run public companies, where they have very substantial Wall Street experience, and where they're going to commit to stay with the transaction. They're not going to take off, 2 months after the close. They're going to go on your board. And I would just, I would make that an important part of the vetting process of which SPAC you choose, rather than focus exclusively on valuation. I'll talk about more why I think that's an issue. And then, the other reason is we talked about flexibility to raise capital. The companies that are already public in the U.S. always raise capital the fastest, especially if you execute. If you don't execute, it's not going to work out, but if you execute. So this is kind of the SPAC life cycle. I think we've kind of covered it. I don't need to go in great detail here. So these are what we think are the 3 keys for a story to work. And by work, we mean work with public investors. And these are the factors that we think you need to attract. So first of all, a scaling business with clear differentiation. So people, if they're going to take what they see as the added risk of investing in Asia, and that's maybe fair or unfair, but that's the perspective of most, I think, US and even European fund managers, they expect to be rewarded with outsized growth. And so they're going to be looking for a company that is growing quickly, that has a large addressable market. So it's not a trend that's been growing quickly for 2 years, but that's going to burn out. They can see a runway for future growth. Something to create a moat. That can be technology, that can be a business model, that can be a network effect. Really, it can be a lot of things, but something to create a moat so that your margins are not going to get competed away. That's something we saw so much time and time again in China. Companies would go out with these very attractive operating margins. 3 years later, it'd be a regression to mean they would not be earning their cost of capital. So you have to be able to explain to investors how you're going to do that. And a visionary management team. Sometimes language can be a challenge. I think it's less of a challenge in this region than it is in the PRC, which is a positive. Most of the management teams we work with, are quite articulate in terms of getting the story across. And then from there, translating that into an exceptional investment story, and that's where we see ourselves as partners, creating a very clear investment thesis, laying out robust growth strategy with clear milestones, solid financial projections that you can meet or beat, because this is effectively going to become your guidance, right? So if you come out your first quarter and you miss whatever you put, that's kind of like people don't want to talk to you for a while. And then mapping out the milestones. And then the other thing I think Mitch touched on is, are you public company ready? And a lot of this is process stuff, but it's also a mentality, to be honest. So, do we have someone on the executive leadership team that can convey the story to public investors? Can you get a PCAOB audit done? I mean, that's like number one. You'll hear more about that from Drew, but if you can't get that done, you're kind of dead in the water. Can you put in place sufficient internal controls? And can you exercise good governance practices? And good governance practices means you don't just put all your best friends on your board. It means you actually find, some people who have public company experience, and you find some people who have true leadership experience within your industry who are going to give you credibility, and that credibility is then loaned against the credibility of the company. So break that down a little bit more. Number one is asset selection. You can put lipstick on a pig, but at the end of the day, lipstick, will come off in the rain and it's still a pig, right? So is the business model fundamentally attractive with proven unit economics and a large runway? So that's number one. Number two, can you provide investors with a credible financial model that demonstrates operating leverage over time and ability to become profitable if you're not profitable already? I would say most of the companies we're working with in Southeast Asia, they already have a history of profitability, or at the very least, EBITDA positive. The ones that don't, you can lay out just very, very clearly how they get there as volumes scale. And then, are there US listed comps that can be used to value the business that have made money for investors in the past? So that's, There's a lot of stories that, frankly, will probably do better on the local markets because they're very localized stories, and they have brands that are well recognized. And depending, particularly markets like, Thailand is a very relatively robust market. India lately has, maybe it has some problems today, but up until a few weeks ago was doing extremely well. So there's certain times when it just makes sense to list domestically. But if U.S. comps where these are companies that are well covered, investors want to allocate more capital to them, they've made money in the past, even if they didn't make it in the last year and a half, that helps. And then can the management team withstand the rigors of being public? Are they really willing to commit to the process? So great asset is number one. Number two, and this is, I think, the biggest source of tension, is valuation. I think there's an inherent dynamic with this concept. They used to talk about, maybe they still talk about having a SPAC off, and you would have 5 or 6 SPACs that would come in, and they'd all come in and make their pitch for why the company should merge with them. And a lot of times it would come down to valuation, and the management team would think, well, they're promising me $1 billion, well, they're promising me $1.5 billion, so we'll go with $1.5 billion. They realize that's something that was decided in a boardroom that has absolutely no meaning once you leave the boardroom. So what does this do for you? And the answer is it does nothing for you. It's actually completely counterproductive. So, to go back to these evil investment bankers, when they do an IPO, they look at your comp set and they figure out your relative growth rate and all that, and they generally will discount you by 10 or 15% versus the comp set. Given that the SPAC is a bit of a tarnished vehicle, you're going to need to discount a little more than that, because the critical thing is you need to induce real investors to buy your shares above trust value. So whatever trust value is, 1030, 1040, 1020, doesn't matter. They need to be being willing to bid those shares up to $11, $12 a share, because that's the only way you're going to turn over your shareholder base and get people who actually want to own your stock versus people who just are seeing this as a derivative play. And that's the only way it's going to happen. So you need to be much more conservative with the valuations to have a successful deal, in my opinion. And fairness opinions have definitely add some realism to marketplace, but I've also seen fairness opinions where they're like, mile wide. I mean, they say, well, it could be worth this, could be worth that. I mean, it's like, so you need to really look at the comps, and to the extent you can do price discovery by meeting with, investors really going to put money to work and say, like, what, because that, that's why you do testing the waters when you do an IPO. You want to do price discovery. What is this company really worth? Give your best story, your best shot, and see what investors are willing to pay for it. Because the reason is it doesn't just impact your ability to keep funds in trust. It also impacts your ability to do follow-on offerings. Because I can tell you, if you have a stock that goes out at 10 and trades up to 12 or 13, you're going to have a much easier time doing a follow-on offering than if you have a stock that goes out at 10 and collapses to $2 or $1.20, or you're $1.20, you're kind of in that zone where most people are not going to want to touch you. So that's why I think this is so important. And then finally, investor marketing, and so this is kind of selling my own services here, but I think you really want to treat this as this is your opportunity between when you make the announcement and when you close the deal to tell your story as forcefully as possible to as many people as possible and to as many different audiences as are willing to listen. So really make the most of your deal announcement, make the merits of the deal and the value drivers extremely clear, have a strategy to reach both new quasi-institutional investors and retail investors, and then monitor the changes to the investor base as you're going along. I know Kevin's going to talk later about that, but that's very important to keep track of. Are you making progress in flipping over that shareholder base? So, unlike an IPO, in most cases, this marketing effort is going to be driven by the SPAC and the target, working with an IR counselor, and in some cases with the capital markets advisor. So you need to develop a very compelling investor story, make the most of the merger announcement, have a clear communication strategy, and again, have a series of announcements going out during that time frame that show you're executing your strategy. Act as if you're already a public company. So, there's a lot of people playing different roles out here. Some are, known as capital markets advisor, financial advisor, placement agent. And frankly, they add value in different ways depending on the needs of the company. But these are some questions that I would ask as you're having those discussions. What's their honest opinion of the marketability and the valuation of the deal? And how do they get there? Explain it to you. Are they going to provide non-deal meetings in advance of the close, and with whom? Or are they just kind of let what happens happen and then try and do a deal for you after the close? Will they provide analyst coverage during the de-SPAC or post-de-SPAC? That should be something you get a firm commitment, depending on what kind of fees you're paying them. And can you meet with this analyst? And is the analyst really vetting the deal? Do they seem enthusiastic? Because if they're just doing it because they're told to, they're not really going to be a good advocate for you with the street. And then, if you're looking at more as someone to help you raise capital, I think most of the investment banks these days will be very realistic based on your company fundamentals and value, what they think they can achieve, and what they're seeing in the marketplace, which changes, as you heard, week to week. So, from there, we're looking at the listing ceremony and then getting ready to be a public company. You want to make the most of your listing ceremony on either NASDAQ or NYSE. The majority of the SPACs seem to be headed to NASDAQ these days. Make sure that your very first earnings call, you come off as a seasoned and professional management team. I've seen companies that late reporting. I've even seen a company that put out an earnings release that only had revenue numbers and didn't have, any income statement attached to it, didn't have any balance sheet. And you kind of wonder, what were they thinking? Because it's immediately signaling to investors, you're just not ready to be a public company. And so, why did you go through all this if you weren't? And then, managing expectations. So, you're whatever you put out in there on the street in terms of forecast, that effectively becomes your guidance. But business conditions change all the time, and you could find out you're doing better than you thought. You could find out you're doing worse than you thought. But Wall Street really hates to be surprised at the last minute. So if you realize early on, you're just not going to make that first quarter and you have some legal reasonable explanation, better to get it out early. Similarly, if you're going to do a lot better, than you thought, maybe you do an update to guidance. If you're just going to do a little better, just let it sit. That's kind of perfect. And then the last thing is focus on long-term value creation. So this, I'd say the SPAC is your ticket to become a public company. And you got to think about it as this is like a 5-year journey or longer journey to create value for your management team, for your employees if you have an employee stock option plan, and for your public shareholders. That would be the perspective. So these are different elements of an IR program. We talked about them offline if anybody wants to get into more detail. And then I think, depending on the company, in some cases, leveraging the media makes a lot of sense. If you have an interesting story that's at the intersection of issues that the media cares about, but you need to be thoughtful and strategic about how you position it. And you also don't want to waste resources. If you have a company that's not really going to appeal to the media, you don't want to spend too much time on this. But I think there is the opportunity to, if you have the right management team, the right story, to become this kind of source of quotes that the media goes to, and that kind of increases your visibility with retail investors and institutional investors, and can be very helpful. So this is my kind of summary slide of where I think we are today. So we had obviously SPAC 1.0, and I remember working on a few of those back in the day. It was invented back in 1993 because the SEC had put a ban on what were called penny stock blank checks. which were kind of rife with fraud back in the 1980s. And so this was essentially a way to upgrade and legitimize the blank check and make it a major market product. For many years, it was really a duopoly with really only two, maybe there's a few others, but really two banks that were involved. And then the popularity, of the SPAC began to increase as George already explained, in response to this just like very extended period of, let's call it innovative monetary policy on behalf of the Fed, which suddenly I think was the primary reason for that. So you saw the deal volume rise from, just 13 IPOs in SPAC IPOs in 2016 to 50 in 2019 and then 248 in 2020. That was really the beginning of the takeoff period. So another critical thing that happened back in the day, if you voted in favor of the deal, that meant you couldn't redeem. So that vote was a highly, highly contested vote. And then they separated the decision to redeem, the right to redeem, from the vote in favor of the deal, which made it a lot easier to get deals approved, but also in a rocky market increased the risk of massive redemptions. So then we had SPAC 2.0, which was, I call it SPAC mania, which was basically 2019 going into 2021. And suddenly the bulge bracket banks aggressively move into this market that they'd never been involved in before. Issuance reaches unsustainable levels of the 613 IPOs in 2022. We have these hopes and dreams progressions. VCs find this very convenient place to put their C-player portfolios into the public markets. Meme stocks get exciting, headed for the moon. And then everybody jumps aboard. Private equity, if you're a private equity fund manager, you don't have a SPAC, suddenly you're a loser. It's like you don't have a house in the Hamptons anymore. If you're a famous athlete, you don't have a SPAC, then you're a loser. So everybody had to have a SPAC, and they all jumped aboard for a while. And now then we had the SPAC bust. So where the vast majority of de-SPACs trading at a discount to trust post-closing, with only really a handful of exceptions there last year. More SPACs have been dissolving in recent months, the new SPACs IPOs pricing, and that many de-SPACs that issued aggressive forecasts are now under SEC investigation or subject to class action lawsuits. And those are a lot of fun, both of them. But I'm coming out of this feeling optimistic. And I guess why? Because I think for all the turbulence the last couple of years, we have the potential, and it really comes down to the people in this room and the broader ecosystem to make it happen. We have higher standards for disclosure and liability that makes everybody take this stuff a lot more seriously. I think the oversupply of SPACs in the market will eventually go away over the next 9 months, and supply and demand is going to come back into balance. I think the SPAC IPO terms, once that happens, will probably become a little bit more favorable. I mean, anybody who signed up to do a SPAC merger in 9 months, I think, is insane. Just on my experience of how long it takes to get these things done, like there's no way you can do it. So I think people realize that's unrealistic, and the thing, just things will go back to a little bit more fair terms, more balanced towards the SPAC sponsors. I would say sponsors with committed capital are going to have substantially better negotiating position. So if you have a set of desirable targets, if you can somehow find truly committed capital, that's going to give you a lot of leverage in picking the best deals as people figure out that this valuation competition didn't really make a lot of sense. And valuations need to provide an upside for the public market investors. And, I think this is a good time to actually come in. Again, as I kind of said at the beginning of the day, I remember after the dot-com crash, after the GFC, those are the times when you make, if you're selective and smart, that's where you make the real money. And I do believe Southeast Asia is going to become a major source for quality deal flow over the next 5 years. So thank you so much. I hope it was helpful. And now we're going to go to our panel discussion, which is a little bit more wide-ranging. And we'll talk about SPACs and compare them to other means of raising capital and surviving this capital winter. Thank you. So the topic of this panel is going to be a little bit more, we're going to open up the aperture a little bit and look beyond SPACs, more broadly at the state of the capital markets, and what are the range of options available to growth companies that want to get through this period in which both private funding and the traditional IPO market are, let's just say, suboptimal. One of the, if you can just go back one slide to the intro. One of the risks of doing a panel in Southeast Asia is that everybody is constantly flying off somewhere to do a deal. And so we had, so we've already adjusted. We had Dimitris Haslin was supposed to be with us, and he had to fly off to Indonesia to get a deal done there. And we had Richard Lee, who needed to go to an undisclosed location to try and get a deal done there. So anyway, but I'm very pleased with the caliber of the speakers that we have here today. And I'm going to let both of you introduce yourselves and a little bit about your background and the perspective that you bring to this discussion.
Thank you. And hello, everyone. So by way of background, I've been in probably a longer time. I've been through a variety of incarnations.
We need to adjust
corporate. Hear me okay? I think so, yeah? So I've been in finance all my life. Private equity groups, helping them focus their attention on Southeast Asia. And I don't need to tell this audience, I mean, Southeast Asia, by 2030 is going to be the 4th largest economy. And it's interesting, there's a lot happening in this part of the world, both good as well as challenging. But the reality is the growth trajectory of this region is picking up for a variety of reasons. And in that regard, whether it's private capital or public capital, it's important to bring it to bear to take advantage and help the region expand.
Great. David.
So I haven't been working quite as long as Mark, but
You're probably 45 years old, so.
But I have been working in finance for 20 odd years, but the last 10 of which here in Southeast Asia, having moved over from London. And I think similar to what Mark has said, I think the growth in this region, we can see it. Having started in, frankly, the public equity capital markets, your traditional IPOs, block trades. The significant growth that we've seen in terms of the pre-IPO funding, be it equity, be it debt, be it credit and structured solutions is something that we're seeing happening on a day-to-day basis. And I think that the fact that Southeast Asia, frankly, outperformed as we went through the crisis last year, I think serves us well with regards to showing the strong underpinnings from a demographic growth perspective that we have here, and therefore the significant opportunities for growth that we have.
Great. So I guess, David, I'd like to start with you, and maybe just to frame the discussion, can you give us some data points about looking at the private market for venture and non-controlled private equity funding in 2002 versus 2021, how much of a drop did we see? And anything that you can, contrast versus earlier stage versus later stage and how they fared.
Sure. I mean, I think rather than just looking at 22 versus 21, I think we need to put it into the longer context, right?
Sure.
So I think if you actually look at it on a 2020, 2021, 2022 basis, globally, what we saw in 2020 was 385 billion worth of that growth capital, as we sort of term it. 2021, obviously, an outsized year, 746 billion, 193% growth. But then actually, 2022, we've come back to 485 billion. So, it's a significant drop at 35%. But actually, you contrast that with the 385 in 2020, that's 100 billion extra capital on a global basis going into growth. Now, Asia is a different story. We are basically, 2020, we went from 131, 2022, 133. So you've done that. But a lot of that is driven by, frankly, the China regulatory issues that we saw. Because if you look at Southeast Asia, in the context, you've gone from 9 to 22, and then we only had a pretty small drop, frankly, back to 17 billion in 2022. So I think, again, illustrating the, capital, it continued to be invested in the US in 2022. That was an extremely robust market. But actually, on a broader basis, Southeast Asia performed extremely well as well. Now, to your point with regards to the types of funding, early stage VC and late stage VC remain the bulk of the dollar value of the investing. But I think, if you drill down on a number of deals basis, what you actually saw was that in Asia, the number of deals in 2022 was 54,000 versus 46,000 the previous year. So actually what you saw in 2022 was more deals done, but just less capital on a per deal basis being deployed. And so I think that, we did actually see seed capital continuing to see strong growth through the course of 2022, globally and in Southeast Asia, but early and late stage VC funding sort of dropping off. But frankly speaking, not dropping off a huge amount. I mean, it was down only around sort of 20-25% or so, which in the overall context, not so bad. And you've got to contrast that with public capital markets, which, be it global, be it Southeast Asia, both were down around 60% in the year of 2022, which I think people continuing to look with regards to investing for growth for the long term, and hence private markets holding up much better than what we saw in the public sphere.
So in terms of flow, I guess the story is that the private markets are outperforming. And so even though we read these headlines in Southeast Asia of almost every name brand tech company I can think of announcing layoffs and announcing, their steps to right size and to move towards profitability, it doesn't sound like that was in a reaction to a huge drop in the amount of funding available. So I guess, A, do you have any insights as to what's driving that? And then B, to what extent have the valuations for these kind of high growth but not yet profitable companies mirrored the really rapid contraction that we've seen in the way the public markets thinks about those types of companies?
I mean, I know that we're at a panel which is talking about a capital winter, but I mean, we're certainly not really in a capital winter. The amount of capital available remains vast. Mm-hmm. There is a significant amount of capital that continues to look with regards to deployment. Mm-hmm. It's just a question of where and how it gets deployed. Now, one of the beauties of the private market is effectively, you can have a lot of negotiation, you can do a lot of structuring, to make things work for both parties. And I think that what we saw through the course of the last year or so is that transactions moved from being pure equity to having more of a protected element, be it downside protection through some sort of a CB type of instrument, or other types of structuring bells and whistles, which help make it work for the investor to give them more comfort, but at the same time provides the company with capital. And hence, given that, I think that helps to adjust for some of the differences that we saw with regards to capital deployment across the different markets.
Now, Mark, I think you have a slightly different perspective about how you see the the overall environment for growth capital changing. And I don't know if you want to speak extemporaneously about that, or you have some, okay.
One is higher interest rates. And I think having seen exceptionally high rates in the early 80s, most people have forgotten. Going into, that's going to be a capital winter, because we're going into an environment of significantly higher rates, number one. Number two, across the board, countries are much more indebted than they used to be. And number three, fiscal spending is going up around the world. And not necessarily for good reasons, but for that is going to reverberate across the markets. And higher interest rates basically means your discount factor punchy when you're discounting future cash flows. I mean, this is just basic mathematics. Therefore, growth is not as valuable as value. So that's important to keep that in mind, and you just can't forget that. That higher interest rates are going to have a profound impact. Rates have been going down for 40 years, and these are typically 36 cycles, and we're in that other end of the cycle. And what's fascinating about the market is that it crushes people periodically, so you always get a new group that comes in that basically has forgotten that, and then they relearn the lesson. So that's the first thing, and I just don't want to keep emphasizing it, because then you come across as a bummer, but this is a different world that we're in. Number two, you know, IPOs were down 90% in 22 to 21, SPACs were down 90%. I would argue that 2021 was an exceptional year. And we'll be looking back at 2021 and saying to our grandchildren, well, I used to be there, you should have been there. Right? So you got to forget about it. Remember, that was the height of the pandemic. And think about all the titans of Wall Street and all that other associated crowd. They were at home in the Hamptons, as you were saying, or wherever. And, you know, everyone wants to be relevant. And by being relevant, they were doing deals. And then other people were doing deals. In fact, I even heard about people doing deals in Africa that had never traveled to Africa because they were on Zoom. And I remember distinctly, because I've been an advocate of investing in Africa for a long time, for obvious reasons, demographic reasons, you know, lack of banking facilities, blah, blah, blah. But the crowd, particularly in the States, I was always surprised, because they said, oh, we're never going to make it to Lagos, we're never going to make it to Mombasa or whatever. During the pandemic, that cohort was actually allocating via Zoom. So, and I use that as an instructive point, because if they were doing that on Zoom, they were doing a lot of other stuff. And there's no question about it. Our markets are driven, you know, by fear and excitement, and people got on board this train and they said, boy, this is going very far. And you've alluded to the examples where movie stars and athletes had to have their own SPAC. And if you didn't have your own SPAC, you were a loser. It's, oh my God, I've got to have my own SPAC. We've all heard these stories. So what I would argue is take 2021 out of the picture, and as David was saying, look at 19, 20, and look at that. SPAC is a very useful tool, but like everything else, it needs to be managed, and it's not for everybody. So, I mean, that's kind of my big takeaway. And remember interest rates.
So, David, I imagine that you or your firm is often in the position of you're sitting down with the chairman or chairwoman of a growth company, and you know they have a very ambitious future in mind. They have a lot of things they'd like to do, and they probably ideally would like to do a big IPO somewhere. You know, either in New York or Hong Kong or elsewhere. But right now the market is not just, it's just, in most cases, it's just not there for them. I mean, you know, we saw, I don't know, one sizable deal priced in the US a couple weeks ago, but just not, it's not really there. So as you're talking to them about, you know, their alternatives of, you know, maybe having to do a down round or a structured round of private financing, versus, you know, some kind of debt instrument, versus SPAC? Kind of walk us through that conversation, and to the extent that you think it's relevant to the because we do have a lot of CEOs in the room.
Yeah.
What they should be thinking about as they weigh those alternatives.
Yeah. No, I think there are a lot of different tools in the toolbox, and it all depends on what works for you at the right time in terms of doing it. I mean, I think, as Mark said, I mean, SPACs clearly have a role. The role got blown out of all proportion in 2021. But I think, and I think you flagged also a good point in your intro. I mean, don't forget that going through the de-SPAC route, you've got to be public market ready. You're coming onto the market. You've got to have the right structures, right reporting. You've got to be willing to be judged on a quarterly basis against what you deliver. So I think, frankly speaking, the first thing to always look at is, at what stage do you think your company is? How much more growth, and how risky is that growth? Are you continuing to push into new areas still? Have you actually seen the areas that you're in delivering what you expect to see them to deliver? Because whether it be private or whether it be public, the past is used as a guide with regards to what future performance is going to be like. How easy is it to extrapolate from what you have done with regards to where you are going to go towards? And I think the degree that you are down that path is basically the key way to sort of look with regards to dictating what is the right route for you. Now, I think if you focus on that sort of the growth capital stage, I think as the CEO or the founder, you've always got to think about, okay, so how much capital do I think I need to meet my business plan? But then linked to that, how much dilution am I willing to accept? And it may well be that the amount of capital that you need doesn't work with the dilution that you're willing to accept. And hence, do I go through a multi-step process with regards to getting there? If I bring in a partner, many firms, be it a financial investor or a venture type of capital investor, they've got so much experience across many different sectors, experience with regards to institutionalizing businesses, preparing them for the public markets in the future. Is finding that sort of a partner somebody that I want, or do I think that I'll work better with, as actually being part of a broader strategic operation, but being a sort of a division within that strategic. So these are the sort of the considerations. So I think the first part is, from a strategic perspective, what do I need? Can I do it myself, or do I need somebody to help me? And then linked to that is, if as part of the help, if it's not strategic, if it's financial, how much dilution am I willing to accept as part of that? And you can structure to make dilution lesser if I achieve various plans, but you've got to always be willing to accept dilution. And then as you get later stage, it's obviously a question with regards to, have I put in place all of the governance requirements that I have, audit committee, ability to do PCAOB or whichever audit standards I'm looking at, a board, and being able to budget efficiently and effectively so that I will be able to guide the market with regards to what my next quarter is going to be, guide the market with regards to what my next year is going to be, and explain to them on an ongoing basis with regards to why I'm hopefully beating those numbers, because that's what you want to in a public market environment. You don't want to list, crash, because if you crash, it takes far longer to resurrect yourself having crashed than from never having listed at all.
So I'm going to get to the next question from two different perspectives, and I want to talk about Southeast Asia as a region. And I understand that we're talking about it as a region, and yet the component companies of that region are vastly different. If you look at, for example, the regulatory regime in Vietnam and the infrastructure and the technology training in that country versus, here in Singapore versus Malaysia versus Philippines, these are all very different countries. So I want to ask this question two ways. So for Mark, you're although you've been in Asia before, you're a relative newcomer to Southeast Asia. You've been here since September. Apollo has a very specific way that they look at investing and look at the world. So from that lens, based on what you've seen so far, where do you see the compelling opportunities for the next 5 years? And then kind of flipping the question around, when you're, in the process of going and marketing potential listings, or, it could be 144A for domestic, whatever it is, where do you think that investors were sitting in New York or sitting in Connecticut or sitting in London, where are they in the learning curve of understanding this region, and how well do they get it?
So, from the standpoint of where the action is, more traditional places, and I'm saying this from the perspective of an American-centric investor, you're probably thinking about Japan, Korea, Australia, jurisdictions that are pretty well known, and to a certain extent India. India becomes interesting from the backdrop of, oh my God, and this is pivoting from one enormous economy to another. But given that it's becoming increasingly difficult for international investors, not just Americans, but international investors, to understand what's happening in China, there is this natural reflex to go to the other big economy, which has created, this appetite for what's happening. Of course, the Adani situation is going to give people, a pause to think this through. But I would argue that situation, broadly, the Adani situation, what happened with SPACs in general, what happened with Sam Bankman-Fried, all these things are an outgrowth of this enormous bed of liquidity, and you alluded to it. You said it politely. You said the monetary experiment. What happened in the last 4 years is everything went up. So consequently, many stories were spun about why you should be involved in asset class A or B. And let's be honest, Wall Street, the City of London, is the best when it comes to spinning stories. There's no one better, no one better than spinning stories, getting people excited, and it's like the Dire Straits, the lure of easy money, right? So that's the backdrop. So to come back to your question, you have these countries that I mentioned, and there's also things that are happening where supply chains are coming out of China.
Right.
And those supply chains, which is, historians will look back and say, my God, how did this happen? Because China took a long time to become the economic powerhouse that it is. Why is this happening? So these supply chains are coming out, and they're being reconfigured in different parts of Asia. So there's a big, I don't want to call it a land grab, but there's a big sort of movement trying to figure out where everything kind of settles again. So that's creating other opportunities. So if you step back and you say, okay, yes, there are these traditional countries, Japan, Korea, what's happening in China, and Australia, because it's Anglo-centric, rule of law. But these other countries in this region, in Southeast Asia, Indonesia, Philippines, Vietnam, Malaysia, Thailand, you're going to see a lot of capital coming here because there are things to do. And in some instances, like particularly Indonesia and Philippines, they have great demographics.
Yeah.
And demographics matter.
Yep.
If your population is going to have a median age of 55, in 20 years, you got issues. You've got issues, and this is a pronounced problem in Japan, Korea, to a certain extent here, and it's also happening in China, which is unfortunate because that's happening before China got rich. So the action is shifting towards this region, and this region will attract attention because there are opportunities, and of course Wall Street will spin the story. I mean, you have to make it palatable. But there are real underlying engines that are promoting growth here.
So as our resident story spinner, not to underestimate my own capability in that area, when you and your team back in stateside or London side try to spin the story of Southeast Asia, where do you think people are in the education interest cycle for the region right now?
So look, I mean, I'd echo, frankly, a lot of what Mark said. I mean, I think there's a lot of interest in the region. I think that the problem that many investors have is it's still small in the overall scheme of things, and as each country is so different. You cannot look at Southeast Asia as a single entity. You know, an Indonesian is super different to a Vietnamese. You know, just in terms of how they behave and everything like that, and how they spend. So it's a lot of, the problem is it's a lot of work for people. And so I think that, you know, what you frankly find is that global emerging market managers sitting in New York, sitting in London, they'll do China, they'll do India, and then I'll pick one other country. And generally speaking in Southeast Asia, that's Indonesia. Yep. Yeah. I mean, it's the demographic.
Definitely true for the venture.
And digital penetration and everything like that. So, I mean, but I think that what you will find is because of the move in terms of the supply chains, because of the continuing growth of these countries. I mean, the GDP growth in the Philippines is 7%. I mean, you know, that each of these countries is growing above the global average. So over time, they're going to become increasingly important on a global scale. It's just a question of time. And so what you find at the moment is, frankly speaking, that most investors are investing China, India, maybe Indonesia, but they will look, if you can spin a good enough story about a good enough stock, then they will take a look. But you've got to grab their attention with regards to why this is the one in this country that they need to look at. Because I mean, you talk to, you know, somebody at a Capital or wherever, you know, in the Philippine market, they'll own 2 or 3 stocks only.
Right. And so, you know, one way around that has been, you know, these pan-Southeast Asia plays. So whether it be, you know, C, which was the first one to go out, or, you know, Grab, which went public and the largest SPAC merger in history, I believe is still the record. Or, you know, some that have listed domestically but may eventually list overseas, like Goto and Bukalapak, which, you know, I think have a reasonable, you know, exposure to overseas investors. So I guess if you think of it, and there's certainly a lot of other companies that are not as far along as Grab and C that have a pan Southeast Asia strategy. They had an initial day in the sun. In some cases, a very short day in the sun, like Grab, and some cases, a longer day in the sun. Do you see that as a kind of path forward, or do you think it's really going to be picking country by country, which is the?
I mean, I think that the Goto Bukalapak is possibly the way that you find that companies go. So you do the local listing with local investors who know and understand your business, and then when you have grown and proven yourself out, you go and get a US secondary listing to tap into the deeper markets that are there. And I think the benefit of that, frankly speaking, is because you've got a reference price on a local exchange, it's much easier to just look against that. You know, you've got a track record with regards to publications and performance to look against. And so I think that is a route that many will go down, because I think, you know, with each country being quite different, frankly, many companies, even Grab, even C, have found it very challenging to actually build up a pan-ASEAN platform. And hence, I think it is likely that pan-ASEAN platforms will remain few and far between, I think, with regards to the ones that are able to be created. And hence, yeah, it probably will be local, and then you look with regards to getting a broader thereafter.
Circling back to the topic of SPACs, as I mentioned in my presentation, there was a moment in time when the bulge bracket were all in on this, and, you know, thought it was an amazing money minting device that had been, but it, you know, since the SEC signaled this higher level of liability, I think most have essentially exited, and others have become extremely selective. I know that, I don't know if you were involved since it's more of a China deal, but your firm did advise on the ECARX, de-SPAC. So I guess, what do you see as the future of larger banks with the SPAC product? Will it ever come back as something that you're interested in underwriting, either as an IPO or playing a substantive advisory role? during the de-SPAC process, or do you think that moment is kind of past forever?
No, certainly I don't think it's passed forever. I mean, I think we all agree that a SPAC has a place in the toolbox. You've got committed capital, you can get the deal done, and in many instances, the sponsors of the SPAC have value themselves to bring to the table in terms of merging with them. And I think certainly if you look at the SPAC regimes in Singapore, the idea there is, frankly, about bringing companies onto the Singapore exchange. So I think that it is something that is there, but you've got to find the right one. And I think from our side of things, as we advise companies around the right route to go, I mean, a SPAC is a route for them to consider going, but you've got to accept the positives as well as the sort of the negatives with regards to going down that route. And I think you alluded to it in your opening. I mean, from our perspective, we see it as akin to an IPO. So from the process perspective, from the information perspective, comfort perspective from auditors and lawyers, it's very similar these days. So the timing is definitely not a saving these days.
Okay.
Let me just jump in here because
Because you're on the board of SPAC, so
yeah, I'm on the board of I'm on the board of a SPAC, which just launched about a couple of months ago, and the target is they have a list of 35 companies around the world that are mergers that are targets for this SPAC in the mining space. So this is, if everything goes off, we're going to complete this transaction in the next 3 months, and it will be listed in London. And this shows you there's a great opportunity for certain very focused approach. I need mining. I'm going to be in London. Here's a list of 35 companies that I'm going after.
Right.
Right? Bang. There it is.
Right.
So, and this is exactly what a SPAC is meant to do.
Right.
Is to identify these opportunities and to move quickly and to bring in institutional capital to the right place.
Right.
It's not something for everyone.
Right.
Just to kind of repeat the obvious.
So, last question, and I suspect we're going to get different answers here. What is your prediction for the IPO market more generally for these kind of growth stage or growth-oriented companies, let's say, both towards the end of this year and for next year? What is your crystal ball telling you? And since I assume you're having these conversations with your team, we'll start with you, and then we'll let Mark deflate our balloon.
Well, I mean, what I would start by saying is that 2021 was an aberration.
Yeah.
We should not expect to go back there. And I mean, I think to the point, it's interesting to note that if you look at long run software multiples, where we are now is actually back to where we were in 2018, 2019. It was. Yeah. It's just a normalization.
Yeah.
So as it comes with regards to IPO volumes, look, we are talking to my US colleagues, we're expecting that post Labor Day in the US, that's when we're going to start to see a bit of progress coming through with regards to the US IPO market coming through. There will be some tech there, but I think we are in a world now where profitability is more important. You're going to need to be bigger. You're going to be nearer to profitability. You're going to be easier to understand, frankly speaking. Some of this very speculative stuff, which investors think that they understand, but then they find out that they don't really understand, I think will be later stage. And so that's where we're going to start more traditional, more profitable, more developed businesses. Then 2024, hopefully there'll be a broader reopening, and we'll go from there. I think Southeast Asia we have a few, which I think will start in the first part of this year. But again, I think in line with global trends, second half should be better. And then 2024 looks like it should be back towards a more normal IPO year. But it will be a more normal IPO year in the context of 2018, 2019, maybe a bit of 2020 than what we saw in 2021.
I would broadly be in agreement with that. I don't want to be, so let's be very specific. Companies are going to have to be more realistic about the valuation. Valuation is about metrics, and it's about ego. And I would argue in this environment, you should forget the ego and focus on raising capital because you don't know what's going to happen. So this whole concept of, profitability matters, absolutely. The story, not that exciting. We're seeing a little bit of the same problem with the AI stuff now. People are getting, again, very excited. It's the new dawn. Every time you see people and they just kind of get, their eyes start to get flashing. It's like, okay, here we go again. They're the money spinners. So we're seeing a bit of this. But let's step back. So that's like, you should get the money. If you have the ability to raise capital, don't be funny, do it. And I just want to remind everyone, those of you that may recall Aramco, which had the largest listing in the world, they were obsessed with this 2 trillion valuation, obsessed. And they got it. And how did they get it? I think they floated 2% of the stock.
Right.
And then everyone that bought it was able to finance it.
Right.
With bank, so they got it. But they never really did a follow-on financing. I mean,
Right.
Because in my mind, when you do the IPO, you entice the investors to come in.
Right.
That's the whole point about IPOs, isn't it? Yes, you want to come into the market, you want to establish yourself, but you bring in investors, you're supposed to make them feel good, right? Well, in that case, that stock, you look at the chart on Bloomberg, it hasn't really done anything.
Right.
And it's gone sideways. So get the money, and now comes the bummer. So the next couple of years are going to be very difficult. Anyone thinks they know, we don't know what's going on, right? So people are talking about, for instance, in China, that it's going to have 5% growth. How do you know? There's a whole other, situation that's developing there where you have the disappearing financiers, the appearing and disappearing financiers. We don't know what's happening. We don't know what's happening in Asia. We know what's happening in Europe. And we know that from a valuation standpoint, the U.S. has been kind of frothy. So, making an assumption that markets are going to be constructive the next 2-3 years, that's a very bold assumption. So cash flow matters. Valuations, aspirational valuations are a thing of the past. And I think you just have to remember that rates are rising around the world. And that's not exactly very positive for stock markets. And all this means is that people are going to have to be, if not more cautious, more prudent about the way they allocate capital for investing purposes.
Great. Well, I think that's a great place to leave it. And let's have a round of applause for the panel. And welcome you all to go to lunch now. So thank you so much.